Good morning, afternoon, evening, everybody. We will allow everybody just a few minutes to go ahead and get signed on here, and we will get started. I want to be respectful of everybody's time here and get going as soon as possible. Just a couple of housekeeping items and stuff, guys. If you guys have questions, comments, concerns during the presentation and stuff here, please feel free to put them in the chat box there, and I will make sure that Rick and myself kind of get to those. So if you guys have anything as we're going through. Rick, what part of the world are you in today, sir?
I am in Orange County, California, where I live.
Orange County, California. And then you're traveling out to Inman next week in New York?
I will be traveling on Monday to go to New York City, be there for a few days. And then the following week, we'll actually be in DC to visit the 5-Star Government Forum. So busy couple travel weeks. And yeah. I know you've been traveling as well.
Yeah, I'm actually really excited. I'll actually be going to the policy committee and stuff for AREAA here for the first time. I mean, we've been involved with AREAA for years and years now. This will be my first time attending the policy, which I'm really excited about.
It's always a great event. AREAA does a great job of advocating for its constituents. Unfortunately, I had a prior commitment I can't make this year's, but I'll be there in spirit. I've always enjoyed being part of that event.
Yes. Well, let's go ahead. I see the count here starting to go up. I want to be respectful of everybody's time here. So everybody, welcome. For those of you guys that don't know me, my name is Larry White. I am not only a member of AREAA, but I'm also the current chair for the National Default Committee. We have Rick Sharga, who is next year's incoming chair for the National Default Committee. And I could not be more excited to share just his wisdom with all of you guys here today. So Rick Sharga is a great friend, a mentor of mine. He is currently the Executive Vice President of Market Intelligence for ADAM. Is that correct?
That's correct.
Okay. I've known Rick through a number of different companies as he ran 10X, Auction.com, Carrington Mortgage Holdings, and he's done so much in this industry. He's had more publications and press releases on the pretty much the default sector, specifically on how the market's going. And he's such a great friend of AREAA. And so we generally get him on here at least once a year to update everybody and keep them in the loop of what's coming down the pipeline and what we have here in store. Rick, welcome. And thank you so much for being here, my brother. It's always a pleasure to have you.
Thanks for the build-up. I'll try and live up to that. But no, always my pleasure. I'm a big fan of AREAA, have been for years, and I'm a member, paying member, and delighted to be here and to talk about what's going on in the foreclosure market for everybody who's interested in that subject.
Yeah, absolutely. So, guys, today's topic is post-pandemic foreclosure market. Right? Like what's happening now? So Rick, like I'll hand over the screen and stuff to you. I know we have some data to go along with everything that we're talking about and stuff here. Man, this is such a hot topic, right? We've went through so much in the last 2.5 years now. Where do we even start, by talking, where do we even start to tackle this issue here?
Yeah, it's a great question, Larry, and just kind of to give everybody a precursor to what we're going to be talking about. What you're saying is kind of really an important aspect of this. There was this huge expectation coming in that we'd have a wave of foreclosures at the end of the COVID pandemic, which clearly hasn't happened. So why wasn't that the case? We'll talk a little bit about how the housing market dynamic affects all of this. what the government's role was and how effective they were, what we expect to see at ATOM going forward in terms of foreclosure activity, and what might still go wrong. So we'll cover all that. And I guess the first part of it to your question is, why didn't we see more of the anticipated foreclosure activity? And a lot of it ties right back into the US economy. So normally, historically, you can draw a pretty straight line from economic strength to unemployment rates to delinquency rates to foreclosure rates. And in this particular session, we had the largest single quarterly drop in US history in the GDP, in the gross domestic product. Larger drop than we had in the Great Recession, larger quarter over quarter drop than we had in the Great Depression. So this was an all-timer, and wasn't a huge surprise. The pandemic was declared, the government shutdowns went into play, and the US economy is based about 70% on consumer spending. And all consumers would really be able to spend money on is what they could buy from Amazon or toilet paper and paper towels if they could find them.
Because everything essentially stopped, right? I mean, for about 2 months there, real estate stopped, right? Like I know I backed out of deals. I had no idea what was going on. We couldn't go to stores, like we couldn't go to work, nothing. It literally just stopped on a dime.
It really did. And that's why you saw that huge fall off. 22 million jobs were lost virtually overnight. We've never seen anything like that. But what happened was an immediate bounce back. So the following quarter, we had almost a 34% increase. Now, if you're bad at basic math, like I sometimes am, a 31% drop followed by a 34% increase doesn't get you back to where you were, but it gets you pretty far back. Now, what we had since then, pardon me, are subsequent quarters where the GDP has continued to grow. So at this point, we may not be back where we would have been if we didn't have that fall, but we're back to at least where we were before that drop off. So reason number one why we didn't have the huge foreclosure wave that people expected was that the economy recovered. As part of the economic recovery, jobs came back. We lost, as I mentioned, about 22 million jobs overnight. We went from unemployment rates at about 3.5%, which was the lowest they'd been in 50 years, to unemployment rates that nationally almost hit 15%. And in states like California, we're actually higher than that. And since then, we've seen those numbers come down pretty regularly, almost every week since we hit that peak. The two things I'm showing on this chart, Larry, are the unemployment claims, which is the dark blue columns, and those are new claims for unemployment, and then continuing jobless claims, which means people that filed for unemployment and haven't been able to find work yet. And you can see they both have come down pretty much to where we were prior to the pandemic. And in fact, we're less than 2 million jobs away from a full recovery in the number of jobs. And in fact, there are more jobs available today than there are people looking for work.
So that was going to be with this particular chart here, right? And in some states, there's a limited amount of time that you can apply for the unemployment benefit, 6 months, a year, 2 years, etc. Does that take this into account where some of these people may have dropped off of this, metrics that we're grading, but they're still not actively looking, they're not back at work? Could that go into effect into this?
Yeah, it's a great question. The metric you're referring to, the Census Bureau tracks as what they call the labor force participation rate. So it's the percentage of adults who theoretically could be in the workforce who are actively either working or looking for work. And we did see a drop off in that participation rate during the pandemic, in the early stage of the pandemic, and it hasn't fully recovered. So one of the things you might see is unemployment rates tick up a little bit as more and more people re-enter the workforce. But by and large, what we are seeing is that most of the people who could be working are working right now, and that's accelerated as those unemployment benefits you talked about ran out. So we did have enhanced unemployment benefits from the federal government, from some state governments that lasted longer than normal, that paid higher rates for unemployment than normal. And my theory early on was that that was going to slow down the return of some people into the workforce. Just to give you some anecdotal stories on that, my brother runs a distribution center for a manufacturing operation back in Pennsylvania. Has been having a hard time hiring people until recently, going back to rehire people who were home during the pandemic, who told him basically they were collecting almost as much money on unemployment as they'd make coming back to work. And all things being equal, it was a lot easier for them to stay home.
Sure.
That has reversed a little bit since these enhanced unemployment benefits have gone away. But really, the only sector of the economy that hasn't fully recovered is the service industry. And that was the industry that really took it on the chin during the pandemic. We're talking travel and tourism, restaurants, retail, hospitality, entertainment. And so this is the other reason we haven't seen a huge wave of foreclosure activity. Jobs have almost fully recovered. And to put this in perspective, during the Great Recession, unemployment peaked at about 11%, so below what we saw in the pandemic. But it took us a full decade, 10 years, to recover all the jobs that were lost. The end of the Bush administration, the entire period of the Obama administration, and the early part of the Trump administration, that's how long it took us to recover all those jobs. In this case, we'll have recovered almost all those jobs, actually all those jobs within 2 years. So just a remarkable recovery. So that's one aspect. The other is that a lot of the job losses were really focused this recession on the service industries. And the service industries tend to be populated by employees who are younger, have less formal education, and therefore are making lower wages. And because of those factors, tend to be renters much more often than homeowners. And so a lot of the job losses were really centered in an area that really wasn't going to have an immediate impact on home ownership rates or on foreclosure rates. So in a sense, the housing market, the owner-occupied housing market, kind of dodged a bullet just based on where the job losses were. So 3 really big reasons why we didn't have the kind of foreclosure crisis people were anticipating. The economy recovered rapidly, jobs came back, and the jobs that were lost tended not to be among homeowners. So in a lot of ways, Larry, this was a very, very unusual recession, and the recovery was equally unusual.
Okay, so when we start to talk about the economic recovery, right, was nothing like what we saw during kind of like during the Great Recession, right? And we usually don't see a lot of foreclosures in a strong economy. And you mentioned that the housing market dynamics are also different from what we saw during the last cycle. Yep. So with all of that being said, right, there was a lot that had to do with forbearance agreements, right? There was a lot of preparation on the government, on the bank side, almost like because they were like, oh no, like we've seen this before, right? And last time they were really late to the party with short sales and with all of this. So it almost seemed like they were front loading that and coming onto that very proactively versus the last time. So what, in the grand scheme of things, what does the impact of foreclosure activity start to look like?
So let me kind of break your question into 2 parts. Let's talk a little bit about the housing dynamic this time, and then we'll talk about the government's role in preventing more foreclosures. So everybody who's attending today's webinar and joining us via live stream knows that there is basically nothing available for sale, and there's a tremendous amount of demand. This is exactly the opposite of where we were leading into the Great Recession. So just taking a quick look at current home sales, if you look at January and February, March numbers aren't out yet. They'll probably be out in the next week and a half. But home sales of existing homes are marginally lower, but still pretty strong. How long that will continue is a fair question, because prices going up, interest rates going up, the impact of inflation, we are starting to see a little bit of a potential weakening in demand, but we're still seeing very, very strong home sales. So demand is still strong. Demand is driven mostly by demographics. This is not the kind of speculative buying we saw back in 2005, 2006,
right?
Leading into loans going bad. This is the largest group of millennials, which is the largest age group we've ever had in the country, approaching home ownership age. So the average age of a first-time home buyer today is 33. The largest group of millennials are between the ages of 29 and 32. So there's a lot of demographically driven demand. But this is what I want people to kind of come away with when the question is, well, didn't we see this in 2008? And are we going to expect to see the same kind of fallout? This is from Len Kiefer, who's a senior economist at Freddie Mac. Take a look at where we really were back around 2008. We had an oversupply of both rental properties and homes available for sale, the likes of which we really haven't seen. We had over a year's supply of homes available for sale. The builders didn't get the memo. They kept on building even as the market turned. And as the market turned, home prices crashed, adjustable rate mortgages reset, record numbers of people went into foreclosure, and that added to the inventory. Demand was weak, way too much inventory, prices were plummeting, lenders were making it difficult to get a loan to buy a house, even if you wanted to, and the investment market basically dried up. So really a perfect storm, if you will, that led to huge numbers of foreclosures. Look where we are today. We're at a deficit both in terms of rental properties and homes available for sale. We're at historically low levels of homes available for sale in a market where there continues to be pretty strong demand. So even if somebody does find themselves in trouble and at risk of going into foreclosure, there is a ready market for people to buy these properties, and we've seen that. We're already seeing that happen. Just a quick side journey into new home sales. New homes are selling at a slower rate than they were a year ago. But the reason for that is builders simply haven't kept pace with demand. We'd be selling a lot more new homes if they were available. And only a data nerd like myself would probably find this chart interesting. But what I want to point out is going back again to 2008, look at how many homes had been completed and were available for sale. Just see that spike. That's about as high a spike as we've seen, the highest spike we've seen since they started keeping these records 50 years ago. Okay. Today, we have the lowest percentage of homes completed, new homes completed and available for sale that we've ever seen. But look where we are in terms of homes available for sale where construction hasn't even started. So buyers are in such a hurry to buy a house that they're going out and entering into contracts with builders before they've even broken ground on a new house. So it's a really odd time in the construction market. Builders are facing some headwinds. They can't get supplies. Right. Their material costs are volatile. Construction labor is very difficult to come by. So the housing start numbers have been very encouraging. It does look like builders are going to start building up, but they're just having trouble doing it fast enough to meet demand, and that's why new home sales have been a little difficult.
And does that have something to do with, like, during the, call it 2008 to 2012, right? It almost felt like you saw new home builders going under, construction kind of stopped. So does it have something to do with we didn't keep the same traditional pace of building as we had over the years, and then when supply started going up, we're just trying to play catch up from then on out?
Yeah, you're exactly right. There was about a decade from 2011 to really last year where builders were just building at almost historically low levels. Mm-hmm. So they effectively stopped building after the Great Recession. And to be fair, it probably took them 4 or 5 years just to work through the inventory that they had on their books and trying to get rid of that. Then they spent a bunch of time building multifamily as opposed to single family units because they believed there was more of a need for rentals than there was for owner occupant properties. So yeah, they're definitely in catch-up mode right now. And that imbalance of supply and demand has driven property prices to record highs. We've had, I believe, something like 120 months now of consecutive year-over-year price increases.
Wow.
And we are at all-time highs in terms of prices. Affordability, believe it or not, is a little better than you would expect given that, because the numbers aren't adjusted for inflation. They don't take into effect wage growth. And even with mortgage rates now at 5%, they're still 1 or 2% lower than they were during the last peak in 2006, when it was routine to have 30-year rates as high as 6 or 7% on a property purchase. So prices are at all-time highs, and that's driven homeowner equity to new highs as well. $27 trillion in homeowner equity. And again, juxtapose this to 2008, Larry. Back then, a third of all homeowners were underwater on their loans. So a third of homeowners owed more on their mortgage than their properties were worth. Today, there's $27 trillion in equity, and there's so much equity that even homeowners in foreclosure have positive equity. So almost 90% of borrowers in foreclosure have positive equity in their homes. Look at the far left-hand side, 27% of homeowners who are in foreclosure have more than 50% equity.
Wow. And this is where it's really important as the real estate community, right? A lot of time when people start falling behind, there's an embarrassment, there's an ego, and like sometimes not even all partners that are involved in the transaction know about it, right? Like, and so people will put their head in the sand and be like, oh, I hope this goes away. And so as real estate professionals, this is where it's our job to educate. It's not our job to make the choice and say, this is the best, this is the worst, right? But to really provide consumer options out there. And the more capable you are of navigating through the short sale, the forbearance, all right, all of the different programs that are available to them, the more consumers or customers that you're going to be able to make for life. Because as Rick's pointing out here, there's people that have options. And man, it breaks my heart to think that somebody could go into foreclosure or bankruptcy or something like that and be sitting there, like sitting on this gold mine, essentially.
So my challenge, I'm glad you brought that up. My challenge to every realtor, every loan officer who's joined us today is there are 72% of homeowners in foreclosure who have at least 20% equity. None of them should ever lose a house to foreclosure. None. Now, some of them are concerned about where they would live if they sold their house, and that's understandable in today's market. But my contention is at some point they're going to lose that property, and it's far better to walk away with a check for 20% of your equity and have a fresh start before you've completely destroyed your credit. And every month they stay in that house leading up to a foreclosure. Every month they stay in that house leading up to an eviction. Fees and fines are accumulating, so they have less and less of that equity available to them. To Larry's point, a lot of people, I'm convinced, don't know they have options.
Mm-hmm.
I would also tell you, and this is going to sound weird to anybody in the real estate business, most homeowners probably don't know how much equity they have. So they've gotten a foreclosure notice, which in a lot of cases they believe means it's done. They have no options. They're going to lose their house. They're going to lose everything, and may not even know that they have enough money to sell a house and walk away with a check in their pocket. Yeah. So, the last cycle was very different than this cycle. The last cycle, we had all that negative equity. Most borrowers in foreclosure had negative equity. A lot of these properties didn't sell in a short sale, didn't sell before the auction, didn't even sell at the auction. They became bank properties, REOs. So if you were an agent, if you were an investor, the smart play was to wait for the lender to repossess the property and then eventually put it back on the market, and maybe you get that listing. That's not going to happen this time. Most of these properties should sell prior to the foreclosure auction, and my friends at the auction houses are telling me that the sell-through rate at the courthouse and sheriff sales are twice what they normally are. So there's very, very little getting all the way back to the lenders.
Yeah, I was
so participate in the cycle.
I was just talking. I was just talking with a hedge fund that I work with that literally like they're having a hard time finding anything on the MLS, right? Yeah. So they're starting, and I think there was 9 homes that sold in the auction for Harris County here in the Houston market. They picked up 7 of them, right? They're like, oh my God, like this is how we can get our inventory. And before we kind of go on to the next topic, right? 2 points that I just want to highlight. the point that you said, not even the people that are in foreclosure, but most of our clients don't know how much equity they have in their house. They're not checking this every single day. And so for our real estate community, this is where, like, when I coach and train agents across the country, you should have some sort of a system reaching out, staying in touch. Like, we do a quarterly market update that says, hey, Rick, I know that you probably had no desire to sell your home, but most people love to see if their home appreciated or depreciated. Here's a snapshot. And when you see them open that email 8 and 9 times, and now all of a sudden you call them and say, hey, Rick, I was just checking. Oh my gosh, Larry, I was just thinking of you. Do I really have this? Right? It opens up opportunities. And if you have the right system in place, literally it can be working and adding value to your clients at the same time. And
yeah, at the risk of a shameless plug, that's how a lot of companies work with Adam. We have a product that lets you put together marketing lists based on, and you can do it based on people whose equity has increased, people whose equity has decreased, people that are in the early stage of foreclosure, people that have lived in a house for 30 years. And they also work with our Realty Track website, because that's the kind of site you can. Realty Track's not the only option out there, but I'm not going to give a commercial to anybody else. But where you can get notifications of people entering the foreclosure process. And to Larry's point, this is kind of like the advice they give Chicago voters: vote early and often. And that's really the way to deal with these borrowers, is to make sure your name is the one they think of when the time comes to sell, and be ready to move when they're ready as well. So great advice, Larry.
Yeah. One quick question that we got in from the audience. So I know that most of this data, we've been talking about the United States. We have some members and stuff that are from Canada. Are we seeing similar trends and stuff there? Do you know that? Do you have that data to be able to expand it just a little bit?
I've not been doing a month-over-month analysis of Canadian home sales, but I will tell you that Canadian sales are so strong and prices have risen so rapidly that the government is contemplating legislation to make it illegal to sell a property to anybody who's not a resident of Canada. Now, this is not unprecedented. A couple of the provinces I know put laws in place a couple of years ago, putting a sort of an excise fee on borrowers from China, because there was such a glut of Chinese interest in Canadian properties that I forget what city it was, might have been Calgary, but prices were up something like 35 or 40% year over year, driven largely by Chinese investment dollars. So the Canadian market is, to my knowledge anyway, equally strong right now, if not stronger. Same sort of supply and demand issues, same sort of price increase issues, and from what I understand, very, very little in the way of foreclosures. But that's mostly third-hand data. I'm looking at an anecdotal, okay. So I could be a little bit off on some of those numbers.
Beautiful. So just to recap, guys, right? So the market dynamics are nothing at all like 2008, right? The market was overbuilt. Today, we don't have nearly enough homes to meet the demand. A third of all homeowners were underwater on their loans back then. And now we have record $27 trillion in equity sitting there today, right? So the market conditions and the economy both weigh against another huge wave of foreclosures. But as you mentioned, we lost 22 million jobs during the COVID recession. And it seems impossible that something like that wouldn't cause at least some increase in defaults along the way. Right. So how much of a role did our government programs play in preventing kind of everything from collapsing on us?
So one of my favorite quotes from a president ever was from Ronald Reagan, who said that the scariest words ever are, "I'm from the government and I'm here to help." But in this case, the government really did come riding to the rescue, and in an unprecedented way. In fact, to the point where we lost 22 million jobs, Larry.
Yeah.
And we had the lowest foreclosure activity on record.
Wow.
We in a normal market, about 1% of loans go into foreclosure in a year. So with 55 million active mortgages, we should have expected to see about 550,000 loans in foreclosure last year. That would have been a normal year. We had 151,000. Even prior to the moratorium being declared in the pandemic, we were running a little bit below normal levels. Go back to 2019, we were at about 493,000. So we were a little bit below what we would have normally expected. But 151,000 in a market where we should have had 550,000, just unprecedented numbers. Why was that? Well, the government put a foreclosure moratorium in place that officially protected any owner occupant with a government-backed loan from foreclosures. And all they had to do was raise their hand and say, my income has been impacted by COVID.
Yeah.
Or my financial situation has been impacted by COVID, and they were allowed to not make mortgage payments. But in the meanwhile, servicers were prevented from even initiating foreclosure activity on any loan backed by the FHA, Fannie Mae, Freddie Mac, the VA, or the USDA. That represents about 70% of all mortgages. And even the mortgages that were held in private portfolios, those note holders tended to play along with the government rules because they really didn't want to run afoul of the government or the regulators. So literally nobody was being foreclosed on, with the exception of commercial properties or residential properties that were held in commercial loans.
Okay.
Single family rental properties, for example, or vacant and abandoned properties. So there's literally nothing going into foreclosure. And then the forbearance program, well, let's talk about this. So delinquencies went up, and delinquencies were inflated two ways. And so this chart, if you kind of see where that inflection point happened, where we went up to about 8% of loans being delinquent, that happened for two reasons. One is, and these are MBA loan delinquency numbers that show anything that's delinquent but not in foreclosure. So the first thing you have to remember is a lot of the loans in those green bars that start in 2020 would have normally gone into foreclosure, but weren't allowed to go into foreclosure because of the moratorium and the government's forbearance program. So a certain number of these loans would have rolled off into foreclosure.
Okay.
The other reason these numbers are inflated is because this is when the government's mortgage forbearance program kicked in. So technically, even though a borrower wasn't reported to the credit bureaus as being delinquent, their loans were counted by the industry as delinquent because a payment wasn't made.
Okay.
So virtually all of the loans in these more delinquent stages, the 60 to 90 days, 90 days plus, were loans that were in the forbearance program. And they don't act the way loans previously would have acted if they were delinquent. So, you know, in 2019, if you were a year late on your loans, you were already in foreclosure.
Yeah.
And you weren't going to get that loan cured. In the forbearance program, you could go from being 12 months delinquent to leaving the forbearance program, entering into a repayment plan with your lender, and being current. That just never happened before. So what we've seen anyway is a year now where delinquency rates have come down. We're actually now lower, and this doesn't been reflected in this chart, but as of yesterday, most recent report, we're actually lower than normal levels of delinquencies. So in a normal year, about 4% of loans are delinquent, but not in foreclosure. You see that we peaked this cycle at about 8%. We've been coming down ever since. Yesterday, we actually went below that 4% threshold. And if you look at new loan delinquencies, they're the lowest that we've tracked since the MBA started keeping these numbers back in the 70s. So the government's mortgage forbearance program has been just an unqualified success. It's probably the single best example I've ever seen of the government and the mortgage industry working together in all the years I've been in the business to achieve a positive outcome.
And just so you guys know, that's been a long time. Rick is really old, so he has a lot of data.
I'm 107. I was there when they invented mortgages. This chart shows you where we peaked and where we are today. So the yellow line is the percentage of all mortgages that were in the forbearance program. So we peaked at about 8.5% right after the program was introduced, and we've been coming down steadily ever since. These numbers aren't the absolute most recent. We're down now to about 1.1% of loans being in forbearance,
Okay.
which means that about 500,000 borrowers, less than 1% of all active mortgages, are in forbearance, and they're scheduled to roll out over the rest of this year. When this program started, my two favorite bad predictions, one economist predicted that 25 to 35% of all borrowers would be in the forbearance program. That would have basically bankrupted the servicing industry and made it impossible for anybody to get a loan. So thankfully that didn't happen. And the other was that if you entered forbearance, you were ultimately going to go into foreclosure. So has that actually happened? No. We've had about 8 million borrowers enter the program. We're down to about 500,000 left. Of those, 83% left with a plan in place. 20% actually never missed a payment, even though they were in forbearance. So they basically got into the program to hedge their bets just in case, but never missed a payment. So when they exited, they just continued making payments. Another 12% paid in a lump sum what they had deferred and then began making their payments again. And the biggest group have entered into about 45%. Have either entered into a loan modification or a deferral plan. And the government's deferral plan is remarkably generous. All the payments you left or you missed, and if you're in an escrow account, that includes your insurance and taxes, get pushed to the end of your loan. So if you're in year 5 of a 30-year fixed rate loan, you don't have to worry about those payments until 25 years from now, or when you sell or refinance. So not surprisingly, that's a very popular option for borrowers who have missed payments, but it makes it possible for them to exit forbearance and not immediately default because they had a year's worth of payments to make up. Lenders, servicers also have a lot of tools at their disposal to modify loans, including lowering interest rates. Even at today's rates, some of those rates are still lower than what is on the original mortgage. Ginnie Mae has agreed to allow them to extend the terms of the loan to 40 years, which lowers the monthly payments, and they can defer some of the principal as well. So lots of tools at their disposal. Almost 7% of people left the program by paying off the loan, typically by selling the house or refinancing. And about 17% left without a plan in place. But what the MBA tells us is that about half of them were still in discussions with their servicer about a plan and ultimately roll into one. And the other half actually re-entered the forbearance program. So all in all, less than 1% left with a short sale, a deed in lieu, or a default.
Wow.
Just a remarkably successful program. And of all those people that left, about 82%, and this goes back to June of 2020, about 82% are still current on their loan payments. Now, if you compare that, Larry, to the Great Recession, when a loan was modified back then, it had less than a 50-50 chance of staying current.
Oh my goodness.
This program has been just remarkable. Now, 82% of 83% means some people are falling out. They are delinquent. They're delinquent. They don't have a plan in place. And some of those will ultimately default and go into foreclosure. So at the end of all this, we will see some people enter foreclosure because of the pandemic. Actually, a lot of the people that are not current on their loan payments here were not current on their loans prior to the pandemic, got a reprieve because of the government programs, and now are basically going back into foreclosure. And that's what we've seen at Adam over the last couple of months in terms of people going into foreclosures, is most of the people that have come back into foreclosure are on loans that were in trouble before the pandemic and before the government programs. So we haven't seen a ton of really new activity yet, although we'll certainly see that as we get into the year.
Were there any negative consequences that, like, where we were, moving the problem down the road, like with the banks, are all running businesses, like did it put them into any crunch situations, or were they bailed out by the federal assistance? Like, were there any negative consequences, I guess would be the question, by the programs that were implemented?
Yeah, the servicers were the most vulnerable because what a lot of people don't realize is in a non-payment situation, the servicer's on the hook to keep making payments to the mortgage holder, even though the borrower is not paying. There were some programs put in place by the GSEs and by Ginnie Mae to help offset some of those costs. We saw a lot of loans bought back by the servicers from Ginnie Mae so that they wouldn't have to continue making payments. And that's a fairly typical tactic that the servicers go through. That what was really the saving grace of all this is home sales were so strong. The loan market was so strong that you were raking in record profits from the other parts of your business.
Okay.
While you were kind of treading water and trying to keep your head above water on this end. So no, we didn't have that kind of fallout from the lending and servicing industries that you might have expected.
Okay. And I'm just kind of looking at the guest list here, and there's a lot of familiar faces that have been at, conferences and events and in the default and foreclosure space with us. And probably the question that everybody wants to know is, like, when will we see default ratios get back up to a normal level, right? Because this was a big portion of a lot of agents' business that specialized in this particular space. So when can we expect like a normalcy or kind of a leveling out?
Yeah, I'll jump ahead to spoil the end, but our estimation is that we won't get back to normal levels of foreclosure activity until the very end of 2022, maybe even early 2023. And that's assuming we don't have anything new come out of the CFPB or anything new come from state governments that further pushes out the length of this return to normal. But if you look at the right-hand side of this chart, you can see that even though we're still well below normal levels, we are seeing a steady increase. And I suspect that between now and July, we will continue to see a very similar pattern, which is a double-digit increase in foreclosure activity from the prior month, and as much as a triple-digit increase, over 100% from the prior year. The reason it will start to shift after July is that's when the moratorium ended last year, and we did start to see numbers trickle up a little bit in August, September, October. So we'll probably see a little less dramatic increases, but even with 100% year-over-year increase in foreclosure activity in January, February, and March, we're still off 40-50% from where we were back in 2019. So it's going to take a while. Commercial foreclosures, on the other hand, have gotten back to more normal levels. And you can see there's very few. These are not, it's not, when you see 328, it's not 328,000, it's 328.
Okay.
There are far fewer commercial properties. There's far fewer commercial foreclosures. A lot of commercial mortgage documents are hopelessly complex and have multiple properties on the same note. So you see a lot of other kind of workouts as opposed to commercial foreclosures, but those numbers are back to normal. And in fact, foreclosures on expensive properties with loans of over $5 million are actually running 5 to 10 times higher than normal. But again, it's a very small pool. So you're looking at, instead of 25 properties, instead of 10 properties, you might be looking at 25 or 50. So not big numbers, but those numbers have definitely come back and exceeded normal levels. I borrowed some data from my friend Darren Bloomquist at auction.com.
Okay.
And this kind of shows you where we stand historically. If you look at the chart on the left, there were almost 1 million foreclosures brought to auction in 2010. There were 205,000 in 2019, but 84,000 in 2020. And the 2021 numbers will be even lower when they get the final numbers totaled. So you can see what's going on there. And the breakout here was third-party sales at the auction versus REOs coming to auction on the auction platform. Mm-hmm. The orange bar is something, the orange line is something I call your attention to. The sales rate to third-party buyers at the auctions is up over 60%, when it normally runs somewhere in the 20 to 30% range. So things coming to auction are just selling. On the flip side of that, there's so little that's been coming into the market that the number of distressed property sales is almost meaningless at this point in time. And you can see that particularly on the right-hand side in terms of foreclosures property selling in foreclosure and property selling in short sales. Now, the short sale share looks a little higher, but that's only because there's so few distressed properties in general selling. And so again, can't emphasize this point enough. If you're an agent looking to participate in the market this time, it really makes sense for you to be looking at working with those distressed homeowners early on. It makes sense for you to be working with investors at the auctions themselves. But waiting for REOs to happen, there's just not going to be a lot. There's probably going to be more agents waiting for REOs than there are REOs.
Okay. So just to kind of recap for you guys, right? It sounds like it's going to be a much different market this time.
Yep.
And to be able to service or find this default distressed inventory, whatever we want to put a name on it, right? We need to move to that market early before it gets to that stage, because it may never make it through that actual foreclosure process and back into the bank's hands. So if you're that traditional foreclosure agent, right, how do you change and adapt to make sure that you're relevant in that market space? And that would be a key takeaway if I'm sitting there in your shoes. And so, Rick, it sounds like you're pretty confident that we're in for kind of a soft landing in the housing market. We're not going to see a lot of defaults or foreclosure due to the equity and stuff. Anything that we should keep an eye on that might change this outlook?
Yeah, so we are starting to see more foreclosure activity. And if you're in areas, high population areas, mostly Chicago, New York, Los Angeles, Houston, Atlanta, we are starting to see foreclosure starts. Now, again, a lot of these are loans that were older. They were problem loans even before the moratorium. They're the first ones re-entering. But these are the kind of numbers I was talking about, Larry. So in February, we saw a 40% increase from January and 176% increase from a year ago. But foreclosure starts were still about 40% below where they were in February, and even February 2020, and even further below where they were in 2019, which was a more normal year. But you can see that the orange areas here are areas where we're starting to see foreclosures come back. Some of the blue areas are areas where the states aren't necessarily anxious to see those foreclosures coming back in a real way. So it'll take a while. And this is, and you can all have access to these charts. I don't want to belabor these too much, but this is where auction.com is seeing foreclosure auction volume increase. So the green areas are areas where we're seeing more return to foreclosure auctions. The blue areas are areas where we're seeing a slower return. And you can see for yourself where a lot of that activity is taking place.
Yeah, I know.
So what could be going wrong? First of all, interest rates are going up. And this, to show you how fast this is happening, this is just a little over a week ago, and we were at 4.72%. And Fannie's note this morning acknowledged that the interest rates on 30-year fixed loans are now 5%. So those rates are going up, which becomes an affordability issue. And affordability is one of the things that has been propped up by low interest rates and rising wages. And so that could start to weaken demand. So weakening demand is something I would definitely keep my eye on. It shows up in the MBA's mortgage purchase loan application index. So I know this is a bit of an eye chart, but if you look at the yellow bar, that's what's showing 2022 loan applications. Now, a lot of the drop off is due to refi volume just completely shutting down because of the higher interest rates. But this is purchase loans specifically. So keep in mind that we're now running below 2020, 2019, and even some prior years in terms of activity. So that could be a sign that demand's weakening. Weaker demand can have some impact on the overall market. We've also seen about 9 consecutive months now where pending home sales on a year-over-year basis are lower. The headlines you see from the NAR report are month-over-month declines, but I'm looking at it from a year-over-year decline. Okay. And so again, we're seeing what could be an early sign of weakening demand. And for those of you like me who often look at California as kind of a bellwether in the housing market, The first 2 months of the year, California home sales have been off 8%. And that's been true month over month and year to date. And so if in fact California numbers are an indicator of what we're going to see across the country, I'm not sure that they are, but it's just an interesting data point. Weakening demand could be an issue.
Could that, is part of that due to less inventory as well? Like less home sale, or no, same amount of inventory, relatively just a lower amount of being purchased?
So year over year, we're down about 4.8%, but we're actually up over prior months.
Okay.
So California inventory bottomed out between 1 and 1.5 months. So now we're up to 2 months, still very, very weak.
Sure.
Prices continue to go up. So again, combination of higher prices, higher mortgage rates, little inventory available. And the other thing to point out is, and this is really kind of a bizarre data point, but the number of days on market, while it's off a little bit year over year, it's a little bit shorter year over year, is off its low. So in recent months, that was as low as 6 or 7 days on market. Now we're all the way up to 9 days. So it's taking forever to sell a house. But again, the indicators are kind of reversing where they were a year ago in terms of market momentum.
Okay.
This is something that concerns me a little bit. Consumer Confidence Index comes out of the University of Michigan. Prior to all of this bad stuff happening, the index was routinely at or above 100. Really hasn't fully recovered since the pandemic hit. And it's been impacted a few times by subsequent waves of COVID-19. So it starts to recover, then it gets clobbered by another wave of COVID. But now we have a combination of high inflation, which is a definite top of mind concern for consumers, especially higher energy and food prices, a war in Ukraine due to the Russian invasion, and lingering issues over COVID. Consumer spending, I mentioned, accounts for about 70% of the GDP. Consumers could be talking themselves into reducing spending. Hasn't happened yet, but it could happen, which could lead to a downturn in the economy all by itself. And as consumer confidence weakens, historically, consumers become less confident about entering into long-term financial commitments like buying a house. So something else to keep in mind.
Okay.
I mentioned inflation. Inflation has that consumer effect. We're at 8.5% as of this week, highest it's been in 40 years. I'm showing you two things here. One's the consumer price index, which economists, government economists, I think laughingly say is a more valid measure because it doesn't include volatile things like food and energy. Well, the two most prevalent things on most consumers' minds are probably food costs and energy costs.
Yeah.
And then housing costs right on the heels of that. But both of those are trading at very high levels. They not only have the consumer confidence issue, but if you're paying more for food and gas and heating oil and everything else, that leaves you less money to spend on housing. Mm-hmm. And this could be an issue in the foreclosure market in the sense that people who have very, very high debt to income ratios already, thinking of primarily FHA and VA customers, could be very vulnerable as more and more of their income goes toward, basic necessities. They could be one water heater breakdown away from missing mortgage payments and starting a really bad down cycle. So inflation is really something that I think could be an issue. And then you have to keep your eye on the Fed. The Fed has now announced it's going to be more aggressively raising short-term interest rates, the Fed funds rate. I'm not even worried about what that means for mortgages because they're not directly connected. I'm more worried about the Fed overcorrecting. So historically, 8 of the last 10 recessions, every time the Fed has gone into correction mode, they've overcorrected and taken the economy into a recession. The saving grace is typically, they tend to be mild recessions and fairly weak recessions. But again, the track record is 8 out of 10 times. We've seen the Fed inadvertently push us into recession by trying to get inflation under control or trying to slow down an overheated economy. And they are talking about a very aggressive stance right now, 50 basis points per increase in the Fed funds rate, probably for the next year, and they're talking about 7 to 9 increases. So
Wow.
that causes short-term rates to go up, which causes what economists refer to as a yield curve inversion, which means that suddenly short-term interest rates are higher than long-term interest rates. And for investors, that's completely backwards. And that's usually, again, almost every time is a predictor of a recession. We are very, very close to that inflection point. I think it's almost inevitable we're going to get to it. And the track record is that usually within 18 to 24 months after a yield curve inversion, we do enter a recession. So not something that I'm looking at that we're going to hit a recession by Tuesday, but I think there's a very strong possibility we're going to get to one. And recessions typically lead to job loss. And as I started off this whole conversation by saying, you can usually draw a pretty straight line from job loss to unemployment rates, to delinquency rates, to foreclosure rates. So my outlook for a year and a half to 2 years from now is not quite as rosy as it is in the near future. So just to kind of recap, Larry, and then we can see if we have any questions.
With the stock market or anything like, I mean, essentially since like 2009, I mean, that's been on this bullish trajectory and stuff as well. And we're seeing some signs of softening and stuff on there. Like, could that contribute? Could that like play a role in this as well?
Hard to see a recession where the stock market doesn't get hit as well. The question that the analysts I'm following at least mention is, or the question that they have is, how much of that future outlook is being priced into today's numbers? Because we've seen all three major stock indices get hammered this year. I think the Dow's down somewhere in the neighborhood of 15% year to date. They're all off their highs. So I don't know how much future pain the markets are building in right now, and how much further they might have to correct. Housing market, by the way, because this is one we get asked all the time, we really don't see a likelihood of huge price declines. Still way too much demand, not nearly enough inventory to cause that kind of overbuilt issue. And the fact is that this time around, rising interest rates won't affect most homeowners, because there are very, very few homeowners that are, dealing with adjustable rate mortgages that'll reset. That was really one of the tipping points last time. You had a 2% note that went up to 4%. And most people didn't realize that meant their interest payments are going to go up by 100%. They just didn't do the math. We don't have that scenario this time. In fact, interest rates going up are probably going to keep more people from selling their house, which will keep inventory levels lower, because why would you want to leave a 3% mortgage on a $500,000 house behind to get a 5% mortgage on a $600,000 house?
Sure.
Just doesn't make much sense. So just to quickly recap, most economic metrics today are still strong. Undeniable signals that a recession is a very strong possibility in the coming years. Global events are going to make it harder for the Fed to get inflation under control. The supply chain disruptions, food shortages coming out of Ukraine's one of the biggest wheat producers in the world. It's going to make it harder for the Fed to get inflation under control. Inflation, higher mortgage rates, rising home prices, that's a triple whammy for affordability. I do think we're starting to see the beginnings of demand weakening from home buyers. It's not going to stop, but it won't be as crazy as it was. So, the joke I hear from realtors is they're not getting 30 bids on a house now, they're only getting 20. But it's investors are actually going to be pretty well positioned in this, because they are mostly buying with cash. And so now they have an advantage. As interest rates on mortgages go up, cash becomes a much more affordable way to buy a property. And foreclosure activity is going to increase steadily, but won't be back to normal levels until the end of this year or beginning of next year. So that kind of wraps up our, like a copy of the presentation. I'm happy to share it, happy to have AREAA share it. And it does have some more information about my parent company, Atom Data, for anybody who's interested.
Yeah, perfect. I know Carrie has a copy there of the slides, and some folks had asked about that. So we'll make sure that we get a copy of the slides out to everybody so you guys can kind of review that. We did have one question from Bruce over there in Hawaii. He said he asked recession or stagflation. And maybe you could just kind of touch base and inform what would be stagflation for those that may not know, and then kind of answer the question there.
Yeah, great question. And the easiest way to explain it is stagflation is when the economy stops growing, but inflation is very high. Very often you see inflation go up as the economy expands. Stagflation doesn't occur often. We have had a couple incidents of it, and it is something that economists are looking at as a very real possibility as the Fed has to really slam on the brakes to try and keep inflation from becoming a runaway train. So it is possible you could see consumer spending go down. You could see economic expansion slow down or reverse. And because of other factors like supply chain disruptions, you could see inflation continue to go up. So Bruce, I don't think it's an either or. I think it could be a both in a worst case scenario. I think it's more likely we see a mild recession and GDP growth slow down considerably, and inflation start to come down with it. But just because of how aggressively the Fed is approaching this, but it's not out of the question that we could hit a stagflation situation, and those tend to be uglier and take a little longer to work out of.
Right. Guys, as we're wrapping up here, I'm seeing some thank you coming in, Rick. Again, appreciate everything. As we're kind of winding down, I do see that we're at our hour mark. I want to be respectful. Any other closing questions that we need to get answered while we have our special guest? Just some more thank yous and stuff there. So, man, Rick, it's always a pleasure, my friend.
Same here.
You know, I know that we're starting to travel. I'm sure we will see each other here in the near future as we have more events starting to open up. And so think about that, guys. Like, how do you use this information to position yourself as the market continues to turn? In my eyes, the market is never good or bad. It's just different. And there's always opportunities, right? And the more value that you guys can add to your consumer base, that will be a direct reflection in your compensation, right? The more problems that you can solve for people out there in the marketplace, the better your business will be. So if Rick, if myself, if AREAA can add any value and help you, if you guys want to see more of this, right, at AREAA National, let us know what would help you guys, and we'll figure out ways to put this together. So Rick, again, I appreciate you, brother. Always a pleasure here. And for everybody else, you guys have a great day, a good weekend, and we'll talk to you guys soon. Thank you guys so much.
Take care, everybody.